A and B. This is an option as opposed to in problem 31 we had a forward contract. This is the option. Part A is the cash flow hedge option, and part B is the fair value hedge option. So once again, we've got a problem, and it says on June 1st, Alexander sold goods to a foreign customer at a price of 1,000,000 pesos, and it will get the payment on September 1st. But apparently they're going to do, they're closing their books and preparing second quarter financial statements June 30th. So we always remeasure our accounts receivable and either our forward contract or whatever option. We have to remeasure at balance sheet date and settlement date. So our balance sheet date will be June 30th, our settlement date September 1st. So they, on that same day, they're perfectly hedged. They got insurance. They contracted with Mr. Bankerman to sell those 1,000,000 pesos that they were going to receive at a strike price of 0.062. So that was their spot rate that day. And the price of the option was 0.25 cents per peso. So the first thing that we notice is 1,000,000 pesos times 0.0025 is equal to $2,500. That's the option price. And then they also have that price changes to 0.0018 on June 30th, which makes it an $1,800 price. All right, and we can multiply each of those spot rates. 1,000,000 times 0.62 is 62,000. 1,000,000 times, what other rates do we have? 0.66 is 66,000. 1,000,000 times 0.61 is 61,000. So we've got all the numbers that we need for this problem. First of all, the cash flow hedge. This is part A. And so on the day that we contract, we use the spot rate, the 62,000. Debit accounts receivable, credit sales. And understand, please, that if we were the buyer, this would be debit to inventory or purchases and credit to accounts payable. So it's just this one, we're buyer, you could be the seller. 62,000. And so our T account for accounts receivable has 62,000. The options are recorded on the day that you contract. For contracts are not, but the options are. And so also on that day, we record an option, foreign currency option. And remember, it cost us 0.25 cents per peso, or $2,500. That's the cost of insurance. That's our cost. And we credit cash, $2,500. On June 30th, we need to remeasure the account receivable from 62 to 66. So it went up by $4,000. Debit accounts receivable, credit foreign exchange gain, $4,000. Right here. Also, because it is a cash flow, we use AOCI. So AOCI, and I could have done this, no. Okay, the AOCI is the difference between these two numbers, 2,500 and 1,800. The option price is going down from 2,500. It needs to go to 1,800. It'll do that with a $700 credit. So AOCI is debited and option is credited. And also, when we make that entry, we make this, when we make this entry, we make another one just like it, loss on option, 4,000, okay? and credit to AOCI. And then our option expense is that same 700, option expense 700, and a credit to AOCI. So what we have on the first year is we have a sale, and then we have a foreign exchange gain, which is offset by a loss on the option. They offset each other. And then we have an option expense of $700. Those are the two things on the income statement for year one, which ends, or quarter one, which ends June 30th. But then when we settle on 9/1, the account receivable needs to remeasure from 66 down to 61 with a $5,000 credit. So we will credit accounts receivable and debit foreign exchange loss. And remember that, and I will skip down just like we had here and here, the first and the third. So I'm going to skip that entry. It didn't before, but I will now. And so we're going to have an AOCI for the $5,000 and a gain on option, foreign currency option of $5,000. So this comes from here. You got a loss there, you got a gain here. You got a gain here, you got a loss there. The other side of this is AOCI. In the middle, we have the option expense, or excuse me, the difference between our foreign currency option. It does say, let's see, the $1,000. I'm not sure where they got the $1,000. That's the difference between our spot rate on June 1st and our spot rate on September 1st. 62,000 compared to 61,000. So our option is going down to 1,000 with an 800 credit. So AOCI gets the foreign currency option needs to be credited for 800. The other side's AOCI. And then the option expense, which is our 1,800 change in value because it's now gone to zero. It's gone, there's no option price for that day. So it's gone from 1,800 option price down to zero. Option expense 1,800 and credit AOCI 1,800. And finally then, we actually exercise our option. We get our bag of gold, 61,000. We take our accounts receivables off, and then we remove then we receive the cash, 62,000. The foreign currency option, this one is taken off, 1,000, and we give that bag of gold to Mr. Bankerman. Oh, sorry, 61,000. Okay, so this is coming off. This is coming